Hey there, welcome to another video tutorial. I'm Jim Munchback and I'm going to be walking you through today some of the key things that we look for as we establish a call option strategy. So last time I showed you and introduced you to a covered call strategy using ExxonMobil. By the way, I'm Jim Munchback, CEO of Bayrock Financial, and this video is part of a training series for options. You can go to calloptionstrategy.com to learn more, but that's what we're going to cover today. We're going to introduce you to a covered call strategy, and I'm going to do my best to attempt to make this video short. It's not a 2-minute video. Rarely can I make a 2-minute video, but it is packed with information. So what I want to do is just take you to or through rather the tools and the kind of the metrics that I'll be using to create a covered call strategy. So the first thing we want to talk about or look at, and I'll show you this in in a minute, as soon as I go through. There are 15 topics, by the way, and the first one is key stock selection metrics. So I'll show you what those metrics are, and we'll talk a little bit about them as we go through this video. The next thing is market cap and stability. So we definitely want the stocks that we're using in the covered call strategy to have a relatively large market cap, and the more stable they are, and if you haven't watched the previous tutorial video on the ExxonMobil strategy, that's really an ideal stock to look at in terms of the chart. So we'll cover that again. I'll just review it quickly before we end today's video. Next is just really understanding volatility. We started to talk a little bit about volatility. That's really what causes the price to go up and down and how fast it goes up and down. And that is a really important something to understand if you're considering participating in either your own covered call strategy, or if you decide to let me help you do that. So let's see, I need to jump into the next section here. I hit the wrong. Hold on just a second. Let me see if I can catch up to where I am. I want to get to the bid-ask spread. I think this will be it. There we go. Bid-ask spread is a very important part of trading options of any kind. I'll talk about this multiple times throughout this video tutorial series. But if you just think about it, if you're trading a stock and you're trading options with it, you want the bid and to ask spread to be razor thin. So I'm usually looking for a 1 penny spread. That's between the bid and the ask. If you've never traded options, or you're not really into trading stocks, it may not seem like it matters, but it matters a lot if you're managing a portfolio. So that's an important element that we will talk a little bit about. Price range stability, again, if a stock is a large stock, it's not going to move a lot, and that's what we're looking for in this strategy. We want to use stocks that have a relatively stable price range. Another thing we look at, this is really fundamental analysis, but we do want to kind of pay attention to the PE ratio and earnings. If you just think about a company like Tesla with a very high PE ratio and earnings that can be they can fluctuate quite a bit. It's in some ways a great stock to use for trading options, but I would not want to use it in our covered call strategy, and we'll cover a little bit about that. And that kind of relates to beta and market volatility. Really, market volatility is general. The market can go through times of volatility, and that doesn't mean that the stock we're using for our strategy is as volatile as the market, but beta is really the relationship between the stock and the market and volatility in general. So just a few terms to consider. And again, evaluating fundamentals of a stock is an important part of the process. So we will spend a little time, I will spend a lot of time doing fundamental analysis. Another thing we want to pay attention to is recent price performance. And again, if you haven't watched the video on ExxonMobil, go back and check that out. We'll jump into some charts here in a minute, but just wanted to go over these, kind of what we're looking for, what we're paying attention to, and what I'm certainly paying attention to as we go through these we go through the analysis of selecting the stocks that we will use. In a minute, I'm going to unpack a client's portfolio, and we're going to just go through and look at those stocks in that portfolio so that we can just be really clear about which stocks will qualify, which ones would be ideal and which ones would not. And as we do that, we're going to want to pay attention to the ex-dividend date. So we'll talk about that again in a minute. This is another one of those metrics. It's really should be number one on the list, high trading volume. So if we're trading a stock with a call option strategy of any kind, especially a covered call strategy, we want to select stocks that have a high trading volume. So we'll look at that. And hopefully you can hopefully you understand why these criteria matter. If you don't, then I'll just ask you to trust me as I do the work that I do to prepare and implement the covered call strategy. But these criteria really do make a difference. Before we finish today, I'll try and share a little bit about what's next, what we will be doing in this training series next. But today, let's jump into the I'm going to see if I can get my iPad. There's my iPad. Now what I'm going to do is I'm going to find here we go. This is what I'm showing you right now on my screen is just a list of let me see if I can get my screen set up the way I want. This is a list of stocks and holdings that is actually in a client's portfolio. So I'm going to go through these. Naturally, if we open the ExxonMobil stock, this is a chart. You can see ExxonMobil today is down, and this is definitely one that we would want to have in our portfolio. When I say our portfolio, I'm talking about the selected stocks that we will be using to run the covered call strategy. So this is definitely one that we want to use. So let me just get rid of all this extra stuff and see if we can dive into a few charts. So this is ExxonMobil. If we go to options, we can see what options are available and get a sense of the price. So just so you know, if you look at, this is calls, this is what we're going to be looking at. There's puts over here. That's a different strategy altogether, but we're looking at calls. We're looking at calls. And you can see here we have different expiration dates in this side. So if you just pay attention to this section right there, you'll see we have expiration dates. So if we click into one of those, in fact, if you look at the number of days, that's what I pay attention to, is the number of days. So we want to pay close attention to we want to select an expiration date that's generally 30 to 45 days for this strategy. So when we open this up, this is ExxonMobil, and we can see here as we look through these numbers over here, pay attention here. On the left side of the screen, we have calls, and that's what we're looking at, is calls on ExxonMobil. ExxonMobil is the stock we're looking at. So if you want to get an idea, right now it's trading. You can see the trading price is 103 or 113 rather. And not yesterday, but Monday I traded some calls. I wrote calls, sold some calls on ExxonMobil. And let's go back to the chart real quick and remind you why this stock is an excellent candidate. It has this, we're looking at a 6-month chart here. So that's a 6-month chart. And you can see that this pattern, the pattern in this stock, ExxonMobil, it doesn't have a radical up move or a radical down move. It kind of stays in this pattern, at least for now. It won't stay in this pattern forever, but this is definitely one of the best, I think, one of the best candidates for this strategy because of this consistent pattern. We're looking for a high probability of success. So Monday, the stock was trading up here. Look at that. If you just pay attention to the chart near the right side, you'll see that Monday it was trading around 117, close to 118, and that's when I opened an option on that. So we do have clients with a lot of holdings in ExxonMobil, and this is one that we encourage our clients to take advantage of this strategy. So you can see the strike price. That's what we're looking at, is this strike price right here. And we're paying attention to these numbers. That's the strike price. So what we want to do is be out of the money a bit. So Monday I was trading this option right here. I was opening the call option for, I think it was a 118, I'm pretty sure. So if you look at that, that has gone down. You can see it's down 26%. Okay, so that's outstanding. I mean, that generally it's difficult to time. It's very difficult to time the market. But again, when you're looking at a chart like this, and I pay attention to this every day. So when we look at the chart like this, I'm wanting to just kind of pay attention to the ups and downs, the highs, the lows inside that pattern. So I would not have traded a call option. I would not have written a call option or sold a covered call if it was down at the bottom of that range. But it turns out Monday it was up. Oil's been down, so it just seemed like a good time. So I did put a call option on ExxonMobil. So that was kind of cool that it worked out that way. I hit the wrong button there. I will go back and find the right button if I can. Sorry about that. Okay, here we go. I'm just going to take you back to this chart. So that's ExxonMobil. Let's go back to the, I'm going to go back to the portfolio if I can get there. So these are the stocks we have in the client's account. What I want to do now quickly is just, I'm going to put my face back up here for a minute. What I want to do, the whole goal of this tutorial video, is to take a portfolio. This is a client's portfolio, and look at the stocks that are in the portfolio, because what we're going to try to do is make sure that every one of these soldiers in this portfolio has a very specific purpose. So if it's a growth stock, that's its purpose, to grow. If it's ExxonMobil, typically the reason it's in the portfolio is because it pays a really good dividend, a very reliable dividend. So that's why ExxonMobil would be in your portfolio. It's a great company, well managed, very strong, very large. So what we're doing in this strategy, though, specifically, is we're trying to find companies like ExxonMobil in different industries that we can use to create this strategy to generate income. And that's really what we want to do. We want to generate steady and reliable income, an additional stream of income. So if you're holding these stocks and you have 100 shares, we can open a contract, write a contract, sell a covered call, and that produces and it generates premium. So let's look at, well, today would be a bad day to try to, it would be a bad day to try to open or sell or write a call on ExxonMobil because it's down and it's been down. You can see it's been down. But what about Verizon? Let's look at Verizon, look at that chart. Now that's a chart that's a little different. We have a 6-month chart. Let's look at a 2-year chart. We're looking at a 2-year chart there. So you can see that's a 2-year chart on Verizon. What do you think? I'm thinking this is probably not as good, but let's just look at the options chain and let's see, do we have, first of all, we can see that the stock trades a pretty decent volume, which is always a very important element or characteristic or metric that we're looking for. And it trades at a penny spread, I do believe. Let's see, what is the bid and the ask. So remember, we want a very thin spread between the bid and the ask. So we have a 1 penny spread, so this stock fits. Let's just see. I'm going to jump over here and change my screen so you don't have to see my face, but we can just look at the chart. And I'll get that out of the way for a minute. And so as we look at this chart, we want to jump into the options and see what we have. So again, we want to go out, I'd say this November 120, this is, so if you look right here, I'm looking at this 1 November, that's the 1st of November, and the 24 is for the year 24. And again, we're looking at these days to expire. So it's a little bit hard to see, but I'm looking at these days to expire, and I like 30 to 45 days. So I'm going to, for Verizon, I want to see what is the action looking like. And so we've got open interest, there's not as much interest. The open interest, we're looking for how many contracts are being traded on this. So again, we're looking at the strike price. It's trading right now at 44. So if I was going to do a covered call on this stock, let me go back to, I want to go back to the to the chart. I want to see a chart. So let me go here. Verizon, show details, and where am I? Chart. Sometimes I forget. I get confused. This is Thinkorswim. It's great software, but I use it. I'm using it on my iPad right now, so it's a little different. So anyway, when we look at this chart, this would not be a bad time, in my opinion. I'd have to do some more fundamental analysis, figure out what's going on with this stock, why is it up, and what would cause it to go down. And I haven't done that research yet, but I would want to do that before I make any changes here or make any trades on this stock. But it does look like now would be a good time to consider a call. So we go back and we could check the news. I would do some analysis, but this is the news. And these are the things we want to look at when we're going to be trading options of any kind. But the whole goal here is to minimize risk and increase the revenue in the portfolio. So for this stock, I'm looking at a strike price. I'd say let's just look at a strike price. So what we have here, let me get my face out of here. You don't need to see me. There we go. By the way, I'm working in my studio today in the RV, so you can see that I have a very limited space with a lot going on, and it's this thing here that I'm pushing the buttons on to go from one screen to another. I push buttons on this thing right here, and it takes me to different places. Like I'm going to go here, Now see, it's easy to get confused here, so I'm going to go to iPad full. So that takes me to my iPad, which is where I want to be. And I wanted to just show you, like, this is where I'm always looking. This is where we need to look. This is where the strike price, so the strike price, this is the strike price, needs to be out of the money, which means over and above the actual price. So if we sold an option on this, we could get, whoop, didn't mean to do that. We could get, for $46, we could get 47 cents a share. And that's up 4%. You can see that's up 4% today because the stock is up. So again, this is one I'd have to do some research on. I wouldn't kick it out of the portfolio, but I definitely would say that we may want to look at other stocks. So let's go back and look at the other stocks. VTS, that's Vitesse Energy. Let's take a look at that stock. It's in a pretty interesting pattern. I mean, the pattern is not bad. What about volume? Let's see, well, okay, so this one, now I would say let's not even bother, because remember, we want a very thin spread, and this one has 8-cent spread. That's just not what I'm looking for. So if we look at the 6-month chart, it's not showing us what the, oh, there we go. I wanted to see what the volume was. So it's got not near as much volume. I'd say we pass on this stock. So VTS isn't going to work. Let's look at Southern. We've got what kind of volume? We have pretty decent volume there. We have 2-penny spread. That's not bad. So let's just jump in and see what the options look like. If we go to November, strike price over 89. So we get down to here, and we see we're getting a bid ask here of 155 and 170. So that's what I'm looking at. It's pretty big spread. Open interest is, where is open interest? I'm the wrong. Implied volatility. So these are all of the things I would look at before I trade, but I'm just looking at open interest right now. Open interest is telling me how many contracts we have. Whoops. So that's what I'm looking at. So I'd want to trade, generally, we would want to trade something with a high number of open interest. It just makes it easier to trade. And so you can see that if we go to the bid ask, it gets a little bit closer. Anyway, that's one that we could maybe think about, but I'm not. It certainly doesn't appeal to me the same way ExxonMobil does, because when we look at the chart, if I go back to the chart, okay, show details. I want to see the chart. Get that out of the way. That's a 6-month chart. What do you think? It looks like a stock that's going up, up, up. I'm not sure why. I haven't done any research on this stock. But this is a stock that client selected, I do believe. I know I did not recommend this stock. It's in the portfolio and it's doing well. This is a 2-year chart right there. So I would not think this would be a good candidate for our covered call strategy, because it looks like it may have it could have some upside, potential, and we wouldn't want to miss that. So back to our list. Let's see. I know that the SNVXX is a money market, so that's not going to work. Pfizer. Let's look at Pfizer. This is a 2-year chart for Pfizer. What do you think? I would think that if we were selling calls on this one over the years, we would have been able to cash in that premium and keep all of that premium. And let's see, what's the dividend on this stock? Dividend is 42 cents. So it probably fits all the criteria to sell covered calls if we owned Pfizer, which we do in this case. It's a penny spread. I'm sure it has pretty high volume. It does. It has good high volume. But I don't know. It's not one that I would think we would want to focus on. Now NVIDIA, this is one I've traded options on NVIDIA. Again, this is a 2-year chart. Let's go to a 6-month chart just to get a little bit more. So in this 6-month chart, you can see that, let me see, there we go. I think I went to the wrong, yeah, that's me. This 6-month chart on NVIDIA, you can see it's had some movement. And it's in a pretty tight pattern right now, so I'm not sure that. Let's look at the options, what they pay. So let's go to November 1st. That's good enough. It's a weekly option. Look at the premium. You're getting $24. That's a lot. And it's because the stock is so volatile. So if we sold a covered call on this stock, on NVIDIA, we would be taking a risk, because if this stock goes back to its all-time high, 140 looks like it's 140 looks like it's the high, and if we go back to that, then we would be losing. So we don't want to do that. I would trade. If I owned this stock, I would definitely sell calls, because I'm happy if it gets, I'm not happy if it gets called away, but if it gets called away, I'm just going to wait. You can see the stock is going to go down, and eventually I'm just going to buy it back. And typically I'm trading in a tax qualified account, so I don't have to worry about taxes. But NVIDIA is definitely one I would want to have some conversations with you. If you were a client, you own NVIDIA, and I have had this conversation with a couple of clients. NVIDIA is, in my opinion, not the best, most ideal candidate for the covered call strategy, but it's definitely one that has it gives you the kind of premium that makes the risk worth it, in my opinion. It does require quite a bit of paying attention, but that's what I do every day. Look at these charts and pay attention, and I trade these options in my own account as well as clients. So NUSI, Nationwide NASDAQ, I'm not even sure what NUSI is, but I'm looking at that chart and I'm looking at that spread and I'm thinking probably not. Plus I look at that volume and I'm like, nope, move on to the next one. NLY, Analik, now I should know this company, but I don't. It's got a penny spread, that's nice. It's got volume, decent volume. What else do we want to do on this one? Look at it's a 6-month chart. I always want to look at the 2-year chart and just see what it's looking like. Yeah, this might not be a bad option. So let's just jump into the option chain and see what we got. So we'll go to November 1. Bid ask. Look at the spreads there on the options. They're pretty wide. Look at open interest. That's always a little scary when you're looking at open interest with that. But let's get down. You're going to see much more open interest typically when we get down into closer to the money. So check that out. You can see there's much more interest. Those are the ones we would want to be trading. So let's just look at the price, if I can get this to cooperate. It's trading today at $20. So if it's trading at $20, sorry about that, I'm pushing the wrong buttons again. It's trading at $20, and we want to look at something out of the money. So we would look at, let's say, and this is 36 days out, and boy, I'm not seeing, this is just, look at that. So bid ask, there's a lot of zero bids, even on the one that has, oh, that's the wrong, I was going to say, let's look at the open interest. So this one has, gosh, that's not, So this one has a lot of open interest. This one right here. So let's look at the price. It's just not looking good to me. I don't think I would want to trade that. The market's open right now, so this one is trading options, and it's just not appealing. So let's go to MPLX. I forgot who this is. It's got a 2-penny spread. So do we want to sell this one and buy some more ExxonMobil so we can do this strategy on Exxon? That's really what I'm trying to do, is decide, do we want to, if it's your portfolio, do we want to sell this holding and take a look at another stock that we can have more shares of so that we can sell more contracts so we can make more money. So I'm looking at the volume here. It's got decent volume. I'm wondering what kind of dividend. It's got a decent dividend. So we might want to take a look at this one. Let's just jump in and look at the stock, the options rather. So one thing I'm seeing here is, let me get to the full, you don't need to see my face, but it doesn't have as many options trading. It's not ideal. It's not an ideal candidate in my opinion because of that. Because again, we're looking for stocks that have a very, very active market, options market. That was one of the things we were looking at. So anyway, we'll come back to, well, we won't come back to that one. We don't need. Now here's one, Altria. I know this stock has everything we're looking for in terms of the metrics. I mean, it's going to have high volume. I know that. I think it's got a pretty good, it's got a pretty good dividend. So it's got a good dividend. It's got plenty of volume, and I guarantee you we're going to see a very, very active options market, which we do. So let's just go down to November 1 and see what it gets for 36 days out. So look at that. The bid ask, those are good numbers. I mean, it's a pretty high, imagine getting $7.85, $10. Let me get to the money. This is more realistic. It's trading at 51. So we're looking at a strike price, let's say 52, 36 days out, and we're getting, how much are we getting? We're getting 80 cents. Look at that, because why is that option so down so much? That's how options work. They move around a lot. So the premium that we would get on this trade, if we did it in the money, pretty decent trade. Again, if we go to the chart, do we really want to take a chance of selling a covered call on this stock when it was at 55 bucks just a couple weeks ago? And I say no, we don't want to do that. I mean, it's not a consistent pattern. It's not a stock that I would think we would want to mess with for this strategy. So a few more. I'm going to bounce through these pretty quick. Kinder Morgan, another stock that I've traded lots of this stock in my past. But if you take a close look at this one, you see we've got the penny spread. That's good. Let's see. I think we've got dividends. It's not a great dividend. Another thing I mentioned in the intro is this ex-dividend date. I always have to pay attention to that. It's one of the things that, like, we don't want to be called away on a stock and miss out on the dividend. So I have to pay attention to that. So everything looks decent on this stock. The chart is not really something that I would say is ideal, but it does move in a rhythm. It's just that it's such an upward trending stock that I would be afraid that we would get, we'd get called away, and the timing on this would just have to be right. But let's see what kind of dividend or what kind of premium we would get. So we'll go back down to November 1st, and look at that bid ask. Oh, remember, we want to go to the money. This is where those blue boxes come together. That's kind of where we want to look to get. That's where we would really be trading out of the money, a little higher than the price right now. So if we did, let's say we did a 40, this is 36 days out, how much money would we get? It's not a lot. If we did a 22, which is probably what we would do, we'd get 44 cents a share on a $21 stock. That's not terrible. You can do the math. If we did that 6, 8, 10 times a year, what would that do? That's the way we look at it. I did the math in the last tutorial video. You can go back and check out that post. And again, if you want to check this out, go to calloptionstrategy.com. That will take you to a page on the Bayrock website with a playlist, a YouTube playlist, where this video and the other videos we do for this strategy will be there. This is educational, and that's what it's for. So check that out. So we're looking at KMI. Here's another one, I think, IBM, one that we probably would definitely, I think we would like this. It's unusual to me, though. I'm seeing that it's not a penny spread. That surprises me. I'm not sure why. It's got a decent dividend, not super awesome, but not bad. The ex-dividend date is 8/9/24, so the next one is going to be probably, I think it's at frequency quarterly. So you can see there it's quarterly frequency. So again, I haven't done the research on IBM to know whether or not this is one I would want to trade, but let's jump in and just see what that looks like. Again, we're looking at get close to where the money is. And if we sold an option, if we wrote a call option on this, if I owned this stock, I would definitely be selling calls. Excuse me. And that's what we're looking at. At least that's my first initial thoughts are. I would be looking at, what was the last price? What might we get, for premium? And that's not bad. I think it's $200, $220 stock. So I would have to do a little more research, but I would definitely think that IBM would make the cut. And it's a different industry than ExxonMobil. So the only problem is now I'm looking at this chart, and let's go to a 2-year chart, because this is what we really need to figure out. If you're my client, if this is your portfolio, if you own this stock, do we want to sell options? Do we want to write call options on this? If you own the stock, do we want to use this stock to generate more income? Is it really going to be a protecting or managing your risk? And I think it is. I think that, I went to ET. What did I do? I think I was supposed to be in IBM. Yeah, sorry about that. So here we go. IBM. So IBM, I don't know. I'd have to do some more research, but if I go to a 5-year monthly chart, let's take a look at that. I'm thinking I'd have to do some research on IBM. I'm not sure. I'm assuming it's the AI chase. I'm not really sure. But yeah, I would think that this stock is probably one that I'd have to do some research. But IBM's looking like a great stock to have owned over the last couple years. If we go back to the 6-month chart, it's just going up, up. This is not the kind of stock that I'd want to stick a covered call on, not today anyway. But again, I would have to do some research. So there's IBM. Oh, Goldman Sachs. I wonder, this one would be good because it's in the financial. There's going to be enough volatility in this, in my opinion, to make it something to look at. If you look at that pattern on that 6-month pattern, you can see it does go up, it does go down, but it has a pretty reliable pattern, and that's really what I'm looking for, because with a pattern like that I can just hang around until it hits a certain level, and then I sell the call, write the call, and then hopefully it expires and we get to keep all of the premium. In this case, this is definitely a stock I would think would make sense. I'd have to do some research. Let's look at the options again. We'll go to November, scroll down to where we get to the money. So there we are, to the money. Let me get rid of that. And let's just take a look at the premiums on this $500 stock. Now, one of the things, even if this was perfect for our strategy, it's definitely not a 1 penny spread. But that at that level, that's not nearly as critical as if it's a $50 stock. But nonetheless, it's just such an high amount to buy shares of this stock. You have to have 100 shares to write one contract. So for that reason, I would just probably pass on Goldman Sachs, just because I'm not going to have enough clients who own enough Goldman Sachs. Now, if I did, then I would definitely take another look, but I don't own Goldman Sachs. I have not traded it since the great financial crisis, when I made a lot of money on Goldman Sachs in that opportunity. So this is Energy Transfer. I've traded this stock a lot over the years. When oil was trading at 26 bucks a barrel back in February, I want to say of, I'm going to say 2016, I made a lot of money on this stock. It was in the commode. But again, looking at the dividend, let me get me out of here. You don't need to be seeing me. We're looking at the dividend. It's not huge, but it's a very low valued stock. You look at the 2-year, I don't think this would be one that we would want to trade options on, but let's just take a peek and get down to, again, we're going to where the strike price equals the actual price or close to it. We're looking at the strike price here. And let's see, I'm curious about open interest. What kind of open interest do we have? There's a lot of activity on this, which is, definitely something I want to look at for what open interest is here. So check that out. That makes it definitely one to look at. And plus, you may think this should scare you away, but when you have that much flopping around in the value of these options, that's one of the reasons I like to trade options, because you have to time it right, but when you're looking at a chart like this and a stock like this, when it gets to an all-time high, sometimes it makes sense to just take the risk. And if it gets called away, it gets called away. You got to own the stock. And that brings up another important part, at least for me, is to remember that if you get called away, we're just going to wait and we're going to buy the stock. So on a stock like Energy Transfer, there will come a day when we can make a really good deal and load up on this stock. And at that time, we might even want to do puts. Now a put, let me get me out of here because you don't want to see me, but the put options is the opposite, and that's not the purpose of this video to talk about put options, but it is kind of interesting to know that if we wanted to buy this stock on a day that it was way down, we would get a pretty nice premium to write or sell a put option, and that's one way we could open a position on a stock like this. So I don't think that this would be one I would be all that interested in using for it's got so much volume, but I don't know, I haven't traded options on this in a long time, so I have to take another look. Listen, I'm going to wrap this up. Let me just go through a couple more real quick. Enterprise products. I'm not sure what this one is. EPD. Do you own EPD? This client owns EPD, and I haven't done any research on it, but I'm just looking. If we look at the chart, it's one that probably would make sense to, if you're going to own it, it would probably make sense to go ahead and write some covered calls. So let's just take a peek and see what November at the money. It's got a, yeah, I don't know. It's not looking like one that I would want to mess with, just because of, I mean, if we look at this contract right here, I'm looking at this contract right here. It's hard to look at that one contract right there, but it's bid-ask, the last, just not a lot of premium, not a lot of juice. It's not something that I would want to mess with. And that's just kind of, that's how I evaluate a stock to see if it makes sense to put it into our covered call strategy. So that's it. Devo, what's Devo? I don't even know what Devo is. It's Amplify. The chart makes me think. So another thing I'm seeing right here is that it's not a penny spread. So I'm just going to pass on that one. And let's go back to, my phone is ringing. I don't know if, hopefully you don't even know that. Because my phone is what I'm using for a camera right now. So that's it for today's tutorial. What we're going to do next is we're going to actually build a portfolio. And I'm thinking we can do, I can manage 6. So that would mean I want to own these stocks in my own portfolio. ExxonMobil is one of them. And by the way, ExxonMobil is one that I might buy today before the market closes today. And I might, in fact, if I were going to open a position on ExxonMobil, what I would do, which I may do, I'm actually looking at it right now, literally, what I may do is I would sell, so I would sell a put option. So what does that mean? And this is not a strategy that I typically do for clients. You'd have to convince me that you are sophisticated enough to understand the strategy and be very comfortable with it. But instead of buying 100 shares for $113, look at that, it's not even a penny spread today. If you wanted to do this, if you like the idea of opening a position in ExxonMobil because the value of the stock is down, and you would think and believe and hope, like I would, that this is going to move up, and that we've got, look at the chart. You know, again, I sold a covered call. I wrote a contract on this stock on Monday, which was really good timing. But if I was, you know, if I wanted to get into this, I would actually sell, I would probably sell, not even at the money. It's actually it's in the money. That's considered in the money. But I might do that. I might do 113. That would be at the money. But look what kind of premium I would get. I'd basically get say a $3 discount. And again, we're looking at puts over here now. This whole video, this tutorial is on the call option strategy, the covered call specifically. But in this case, I just want you to see that that's how I would do it. So I would basically be getting paid $300 for one contract, $3 a share for ExxonMobil. And I might just do that. What I would probably do is just set it as a limit order, which means I would set it so that I got $3.50 a share. The contract would be $350, and set it at a limit and hope that ExxonMobil pulls back a little more, and that this option, somebody wants to short the stock, which is why they would buy my put, because they think it's going to go down. I want to own the stock, so instead of paying full price, I would write a put. I would sell a put contract on it, which means whoever buys that contract has the right and the control to put that stock to me at, in this case, $113 a share, which is kind of what I would be happy with, to get paid $350 to buy 100 shares of ExxonMobil. So now if it drops another $5 or $10 and I use this strategy, I would, if I had enough money, I would do it again. I would even sell some more put options, maybe another couple contracts. But this is one way to get into position. So I think next time what we will do is, let me just go see if I can show you what we'll do next time. Next time, what's next? Next time, I think we will hopefully come to the place where we commit to the 6 stocks that we want to have in our call option strategy. And it is a covered call option strategy. So what I'm going to do between now and the next tutorial video is go through my book of business, identify some stocks that I already know fit the metrics that I'm looking for this strategy, like ExxonMobil, and NVIDIA will probably be there too. And just find out in my book of business who owns those stocks, and then as we have client reviews, I will talk to them, which is what I do now, talk to them about a way to generate a steady and reliable income stream in a volatile market, especially in a market that's going up and down, kind of sideways. This is my favorite strategy. So thanks for watching. I hope you'll, excuse me, I hope you will go ahead and click on the little subscribe button if you're watching on YouTube, and you'll get notified if you hit the little bell. You'll get notified when I do the next tutorial video. So that is it. This is getting posted in YouTube, LinkedIn, X, all of my social media. But primarily, I want you to know that this is being posted to, let me show you where it's being posted to. I think it's in this below. Yeah, it should be calloptionstrategy.com. I haven't set that up just yet at the moment. By the time I finish this video, that'll be the next thing I do. I will redirect that domain, Call Option Strategy, to the page that I built on my website, which has embedded in it YouTube playlist. In this video will be in that playlist as well as the next video. So thank you for watching. I know it was way too long, and I'll try and make it a 2-minute video. In fact, I will create a 2-minute video, but it will just be like the screens that we were showing. So back to this is what you're watching right now is just it's the screens. Let me just spend a minute, in fact, before I end, and just go through these. I'm going to just go through these. So market cap and stability, we kind of covered that pretty well. Understanding volatility, mostly we covered that in the previous video. We could do more about that. Leave a comment if you want more information on volatility. Dividend yield benefits, obviously, hopefully you know that, a lot of our clients and our recommendations involve stocks that pay a good dividend. Option liquidity, you got to see that as I showed you what options are trading on these stocks. It's important. It's hugely important, and I don't want to mess with anything that doesn't have lots of liquidity. The bid-ask spread, remember, we're looking for 1 penny. A penny is what we're looking for. So that is important, hugely important. Price range stability, you saw what we were doing with those stock charts. We were looking to see how much the price changes. We want something that's relatively stable. We didn't spend much time on PE ratio and earnings, but as we get into the fundamental review, we pay close attention to that. Beta and market volatility, I didn't really talk about that a lot, but it is an important thing to understand, and I kind of brushed over it, but I'll cover it again and again. Anything you want me to talk about more, just leave a comment, let me know, and I'll be happy to do a tutorial. Recent price performance, again, that's important, because if the stock is in a upward movement, that's important to pay attention to. Ex-dividend dates, I have to pay attention to that, because everybody I know who owns a stock that pays a dividend, they want to own it on the dividend day, when ex-dividend date, which means I don't want it to get called away. High trading volume, as we said, it has to have high volume to fit into the metrics that we're looking for. And so that's very important. So these criteria, hopefully you understand why they matter. Hopefully you understand that they matter. And I hope that you enjoyed this video. I'm going to end there and go blow my nose. Sorry if that's too much information. You could hope, maybe you couldn't tell, but I have a cold and I'm tired of talking, but I appreciate you watching. And I'm looking, by the way, I'm looking at the chart for ExxonMobil, and it looks like it's moving up. If I look at a daily chart, which I don't do very often, but if you look at this daily chart, you can see that it kind of hit a bottom, and it looks like it wants to jump up. We'll see. This stock is one that has a pretty tight pattern, which is, I think, an ideal stock to trade with the covered call option. So we're going to find 6. I'm going to identify 6 stocks. That's definitely a number that I can handle managing this strategy on. So if you're thinking about doing this, pay attention, subscribe to the channel, follow us along. Go to calloptionstrategy.com. We'll take you right to the playlist, and there will be more tutorials to come. So thanks for watching this video. I'm going to end it now and see you in the next one.